Hey everyone, let's jump right into this. If you've ever looked at a massive corporation and wondered, how in the world do they keep their finances straight and actually legal? Well, you are in the exact right place. In today's explainer, we're going to translate some seriously dense accounting regulations into clear, practical takeaways. We'll be digging directly into the rules laid out in the Indian Companies Act of 2013, mapping out the whole shebang from the absolute basics of keeping the books all the way to the complex mechanics of how companies pay back massive, massive debts. So think about this for a second. Without strict, universally applied rules, corporate finance would literally be absolute chaos. Just imagine a world where every company decided for themselves how to calculate profit. Or worse, they just hid their debts wherever they felt like it. Investors would be flying completely blind. The Indian Companies Act 2013 stepped in to solve this exact problem. It creates this really rigorous, structured environment that practically demands transparency. So here is our roadmap for today. First step, corporate financial rules. Second, structuring final accounts. Third, navigating common adjustments. Fourth, understanding debenture redemption. And finally, methods of redemption. All right, let's dive right into part one, corporate financial rules, the legal foundations. Starting with the foundational law here, under Section 128 of the Companies Act, keeping books isn't just, good practice. It is a rigid statutory requirement. Every single company must keep their books of accounts at the registered office. And they can't just invent an accounting style. They absolutely have to use the accrual basis and the double entry system. But what I find really incredible is the retention rule. They have to preserve these records in good order for a minimum of 8 financial years. 8 years. Plus, these books have to remain open for inspection by any director during business hours. It's all about making sure the company's state of affairs is presenting a true and fair view at all times. But, as we all know, rules don't mean much without enforcement, right? That brings us to Section 132, which constitutes the National Financial Reporting Authority, or the NFRA. Think of them as the ultimate regulatory watchdog. They don't just sit around recommending accounting and auditing standards, they actively monitor and enforce compliance. They even oversee the quality of service of the professionals ensuring that compliance. Basically, the NFRA is what gives these foundational rules their actual teeth. Moving on to part two, structuring final accounts. Show, don't just tell. Okay, so the Companies Act doesn't just dictate what information a company has to report. It dictates exactly how that information has to physically look on the page. Take the prescribed Schedule 3 format for the statement of profit and loss. It is incredibly structured. You start at the very top with revenue from operations and other income to get your total income, and then below that, every single expense is heavily categorized from the cost of materials consumed to employee benefits right down to finance costs. It cleanly guides the reader's eye. Total revenue minus total expenses leads you perfectly to the profit before tax. It leaves absolutely zero room for creative interpretation. And that exact same strictness applies to the balance sheet format, which is also dictated by Schedule 3. Traditionally, you might be used to seeing assets on one side and liabilities on the other. But here, it's a vertical format. It starts with equity and liabilities, which essentially shows the sources from where the company actually mobilized its funds. Then, right underneath that, it lists assets, representing how those funds were applied. This format demands that everything is presented in a very specific order of permanence. A really crucial point here is how the law distinguishes between timelines. Assets are strictly divided. You've got current assets. These are the things expected to be realized in cash, sold, or consumed within the company's normal operating cycle or within 12 months. Think inventory or cash equivalents. This is your short-term liquidity. Non-current assets, on the other hand, are your long-term stabilizers. Things like property, plant, equipment, and long-term investments. Drawing this strict dividing line is genius because it prevents companies from masking long-term risks as short-term cash. All right, part 3, navigating common adjustments. The dual impact. So business doesn't just neatly stop on the last day of the financial year. Accountants are constantly dealing with unrecorded transactions at year-end, and because they're using a double entry system, every adjustment has a dual impact. Take outstanding expenses, for example. These are bills you've incurred but haven't actually paid yet. To show a true and fair view, you have to add this to the concerned expense in your profit and loss statement, which, of course, reduces your reported profit. But simultaneously, because you still owe that money, it absolutely must appear on the balance sheet as a current liability. Conversely, if you have prepaid expenses, like say you paid next year's rent today, you deduct that from this year's expenses and list it as a current asset, since you'll get the benefit of it later. Make sense? Now, that same balancing act applies to inventory and income. Closing inventory, the stock you have left over on the last day, impacts your cost of materials in the P&L and sits squarely as a current asset on the balance sheet. And what if you receive income in advance? Say a customer pays you for services you haven't delivered yet. You can't just claim that as profit. You actually have to deduct it from your income in the P&L and record it as a current liability because, technically speaking, you owe them that service. Which brings us to part 4, understanding debenture redemption, the big payback.
Okay, so a debenture is basically an instrument a company uses to borrow a huge amount of money from the public with a promise to pay it back with interest. But how does the law ensure a company actually has the cash on hand to pay back millions in debt when maturity hits? Enter the Debenture Redemption Reserve, or DRR. Under Section 71(4) of the Companies Act, this is essentially a legally required piggy bank. A company has to create this reserve out of profits that would otherwise be available for dividends. Why? Because if you just repay debentures straight out of your core capital, you're going to deplete your liquid resources and cripple the company's daily operations. The DRR is there to protect liquidity.
Let's trace how this builds across the actual lifespan of a debenture. Step 1, the company issues the debentures. Step 2, as time passes, they siphon off a portion of their profits into the DRR. Step 3, and this is a big one, they don't just leave that cash sitting under a mattress. The rules require them to invest a specific percentage of it into approved safe securities. This is called the Debenture Redemption Reserve Investment, or DRI. Step 4, when maturity finally hits, they use these liquid funds to redeem or pay back the debenture holders. And finally, Step 5, once the debt is totally cleared, whatever balance is left in the DRR can safely be transferred back to the General Reserve.
Finally, Part 5, Methods of Redemption, Choosing the Path. Repayment actually isn't a one-size-fits-all process. Companies have a strategic choice in exactly how they cancel their debt. There are multiple paths a company can take. For instance, if they create a DRR, they can redeem the debt in a massive lump sum at the end of the term, or they can pay it off slowly in annual installments. But they also have the option to redeem by purchasing their own debentures out in the open market, or even by converting those debentures directly into company shares. Let's zoom in on that open market option for a second, because it introduces a really clever financial mechanic. If a company buys back its own debentures from an investor halfway through the interest period, how do they handle the interest that's built up? Well, the purchase can be cum interest, which means the total price they pay the investor includes the accrued interest up to that exact date. Or it can be ex interest, meaning the purchase price is strictly for the debenture itself, and the accrued interest is calculated and paid separately. It's a really vital distinction for exactly how the cash flows out of the company.
So we've walked through the rigid rules of Schedule 3, the double entry adjustments, and the heavily regulated process of paying back corporate debt through a DRR. And it brings us to a final, pretty provocative thought. How do these rigid accounting standards ultimately protect investors and the wider economy? Well, it's simple. By forcing companies to be this transparent, to visually organize their assets, strictly record every single unpaid bill, and legally ring-fence profits just to pay back debt, the Companies Act ensures that the financial statements you read are not a work of fiction. They're the ultimate safety net of the modern financial system. They ensure trust, and they ensure stability. Thank you so much for joining me on this explainer, and I hope this gave you a solid structural understanding of corporate accounting.